that is bond, and why actually bond is needed, that we discuss first, and then we slowly means discuss everything about that particular thing. Okay, so anyone who can tell me what is the bond? Anyone who know what is the bond? Okay, so I start. How means how I can generate the fund, how to raise the fund. That is the first point in my mind. If I am the organization owner, then how to raise a fund. Okay, so how to raise a fund? There means we already discussed. Like first one, by use of the stock market, means you need to register your organization into the stock market. Then the people will invest in your organization after means analyzing and after seeing the future of your company. They invest in your in your organization. So they buy the share, and actually they are the owner of that particular company. If they buy the share, then they will be the owner. Okay, so there one thing is the stock. By use of the stock, you can increase the fund. That is the one fund. The next one, if I want to increase the fund, then I will take the loan from the organization, from the bank. Okay, so bank and some financial institute. Okay, there I will take the loan. So there I need to pay approx 11 to 12%. Here I need to give my, or means you can say the holding, or you can say the, as a owner I need to give. If you buy, suppose there is the 10,000 share and you buy approx 100 share, means you are the, means there is a, means you can say okay, I am the 1 by 100 part of the in that particular company. I am the owner of the 1 by 100 part. Like that, actually there is the thing, means they actually hold that particular organization. They actually owner of that particular organization if they buy the share. Okay, but the loan there, actually they say like that to bank. Okay, I will pay the 11 to 12%, and bank will pay, means will give that particular money. So that is the one fund generation thing. So now when you take from bank, so bank where take that particular money, means where that particular money actually got means actually available in that particular bank by use of the people. Okay, so there may be the saving account, as well as there in the bank current account, and the other account available in the FD. Okay, so this, in this term, bank actually get the money. Okay, and there only the bank will pay 5% max to max. Okay, so 5% bank pay on the FD, saving, and the current account, and bank got that particular money. And after that, that particular money will pay to the other organization and the corporation by 11 to 12%. So the thing is like that. Okay, so why we need to go to the bank? Okay, why we need to go? This is suppose public, and public actually save all the money in the form of the FD. So there, okay, I just write here government and as well as corporate. Okay, so suppose sometime government want to increase the fund to run the government. Okay, so what they do, they directly means take a loan from the bank. The another method is like that. Why I need to, means I need to give this 11 to 12% to bank as an organization? Why I will pay? Suppose if I pay 8% direct to this means people or the public, then I can easily get. Okay, it is a win-win situation for the organization, for the public, right? If I escape this bank wala part, are you getting my point? If I directly take that particular fund from the public, then I can escape that bank wala part. Okay, and due to that it is a win-win situation for the organization as well as the for the people. Okay, so I escape that bank wala part, and I means say like that I launch a bond. Okay, in that particular bond I will write like that ki this is the amount of this one bond, and I will give the fixed return to you. Okay, if I am the organization, if I launch any bond, then what I will say, this is the means 10,000 is the price of this particular bond, and after 5 years, that is the maturity period, I will give 8%. Okay, so it is a means in the bond the interest rate is higher than the fixed deposit, and it is lesser than the share. Means in share means you will get high level of the interest, but as well as high level of the risk there. Okay, so okay, so the thing is, the public means here, suppose assume that he want to raise this 10,000, then public give the 10,000 to government, just assume that. Okay, so in that case you will be get 8% as a public, he will return 8% within a 5 year. So the bond actually launched by the government as well as the launch by the corporate also. Okay, so in corporate they also will pay the some percentage, their percentage is 10 to 12%. The percentage rate is high, suppose here assume that the bank is taking suppose 15%, so they also try to reduce, they will give like that 10 to 12 in that case. So it actually varies, the percentage of the interest varies actually from organization to organization. Why? Because some organization like if I talk about the Reliance and that type of the organization, there means they are fundamentally strong. Okay, so they give you the less amount of the interest, but safety is more in that particular bond. Okay, because that are the secure, because company fundamental is strong. Some company recently launched, then there the rate of interest is more, but risk is also more compared to the other means strong foundation organization. So like that actually it is work. Okay, so is there any doubt till now class? Is there any doubt? So the thing is like that. Okay, the thing is like that means here if you invest in the form of the FD, okay, means fixed deposit, you will get the 5-6%, but when you invest in the bond you will get the some high, means compared to the FD you will get the high amount of the return, or you can say the organization will pay high amount of, means high interest. And here means organization will say like that we will give you means every, means there is the two thing, when you buy the bond every month the organization will give you that particular interest, or even you will select a particular thing, there is the cumulative interest. So after 5 year, after maturity of that particular bond, you will get that particular interest amount as well as the principal amount. So that is the thing. So that actually that option is available during when you buy that particular bond. Okay, and how to do all this thing I will show you with the real example. So again means when I say like that the stock market, there means we know that just wait, if I change. Okay, I unable to change. Okay, so when I talk about the stock market, there we know that the return and risk both are high. Okay, return and risk both are high. Okay, why? Because in a stock market we know that if company growth is 200%, then you will get the profit 200%, no issue. But when I talk about the FD, their company growth, that doesn't matter. Okay, so they will give you the means the same amount like 5%, that is the fix. So 5% on your principal they will give you. So they are low risk and low return type of the thing. Okay, and when I talk about the bond means moderate risk and the moderate return. Okay, so here actually risk and return. Okay, so this is the actual thing. So again there means monthly you can get the income. Okay, and the why you need to invest means as a public, why you need to invest, because it actually diversify your portfolio. And why organization need to make bonds, it actually means without means giving the holding of your organization you can generate the fund. Okay, and this is the optimal manner to generate the fund, because The if you take the loan means that is shows the debt of your that particular organization, and you need to pay more amount of the interest. If you go for the stock, then there actually you need to give the holding of your organization to shareholder. So now this is the means the best way. You launch the bond in the market, and there you can write the fixed amount of the interest and the maturity date. You can generate the fund for your organization. That is the one way. So now in bond secure means what is the thing here. Okay, I quickly read all the thing. So an instrument which give a bond is an instrument which give possibility of earning more than FD, as I discussed just, and it is a fixed income security which allow a lender to lend a predetermined amount of fund and be eligible for interest of those fund. Okay, so who is the lender means you, if you are the public, then you are the lender of that particular bond. Okay, and that particular fixed income. So it is a fixed income security which allow a lender to lend a predetermined amount of the fund. Okay, so there means I am the lender, then I will put some fixed amount of the money in that particular bond, and that particular thing will give me per month, or if you are not interested per month, then you will get the cumulative interest. That is the thing. So why invest in the bond? That is the means as a public, I told you just now. I discussed as an organization. Now as a public means why you need to invest. So they can provide current income for conservative income. The next, at a time they can provide capital gain for more aggressive investor. Some bond provide tax free income, and they can be used for the capital means prevention and long term accumulation. So what is the thing when, okay, so bond, if I talk about the bonds of PSUs, in PSUs company like IOCL and many ONGC, that bond if you search on the Google, so there the interest will be 5 to 6%. So it is equivalent to the FD. But what is the profit of this particular type of the fund and this particular type of the bond? What is the profit? The profit is there no tax. Okay, it is a tax free. So when I talk about the FD, at the time of the when you get that particular amount, there some amount means will be deducted because of the tax. But here the tax is not eligible, so somehow you can say this bond is better than that FD. Okay, but yes, if your company bankrupt, okay, so again I am telling you, when I talk about the share, if you invest as a public and you buy some share of any organization, so when the organization means not perform well in the market, and he generate profit in the negative terms. Okay, so net profit in the negative means that organization in the loss, in that particular condition your share value will be decreased. Okay, so you need means you also means your portfolio also decrease. The next point, when I talk about the bond, there means the thing is like that they will give you that fixed amount of the interest. Okay, so there only one risk, if your company, if that particular organization is bankrupt, then they will not give you the return. Okay, but even when a company and the organization is bankrupt, the first thing they will pay all the loan, okay, by selling their assets and all the things, all loan and the liability they will pay. And the second, after that, the bond, there they will give the amount to amount of all the bond to the all public. There they generated actually fund earlier, so that's why they need to pay. And after that they will, if there any amount is remaining, then they will give the shareholder. Okay, the till now means there is, if company is bankrupt, all money will be means I think is covered till now, the shareholder not getting anything. Okay, if bankrupt, then all shareholder lose the money generally. So this is the actually thing, means why it is better compared to the share. Okay, the basic concept of the bond means why, what is the basic concept? It is a long term debt instrument, long term liabilities, also called fixed income security, since interest payment are fixed amount. Okay, so here you are getting the fixed amount of the interest, and means organization also need to pay fixed amount of the interest to the public. So it is a fixed income security, you can say. The borrower agreed to repay a fixed amount of principal at a predetermined maturity date. So here borrower means who is the borrower of that particular fund, that is the organization. Okay, so organization agree to repay a fixed amount of principal at a predetermined maturity date. Okay, so they will pay fixed amount of the interest and their maturity date will be mentioned in that particular bond. Okay, the borrower means the borrower agree to pay a fixed amount of the interest over specified period. Okay, so just I discuss. There is the one thing is generally they mention the coupon rate in every bond. They will means talk about like that. This is the coupon rate of this particular bond. So what is the coupon rate? Coupon rate is means is nothing but you can say the rate of interest. How much rate of interest I will get on that particular bond if I buy? That is nothing but the coupon rate. Okay, so please remember the coupon rate is nothing but the rate of return. What is the tenure of that particular bond? Tenure is means you can say the time span. The coupon payment date, the date declared by the issuer of bond, means when they will declare the bond, declare the date on that particular bond. So that is nothing but the coupon payment date. The date of redemption means schedule maturity date to repay the fund. Okay, so that is nothing but the date of redemption. The redemption value means per value of debt, discount and the premium is nothing but the redemption value. So I will discuss that all the thing. So there again I am telling you there is the two type of the bond you can say. If government want to generate any fund, then also they launch the means bond in the market and they generate the money. The next point, if corporate want to generate a money, then they will launch bond and they generate the money. So here corporate bond is nothing but here the organization who generating this particular bond or who launch this particular bond in the market is the corporate. Okay, is the private entity. So here you can say the bond holder invests in the bond issued by issuing firm by lending money. Okay, and expect to receive interest periodically and principal at the end of the maturity period. So here what is the thing? So bond holder means if you are the bond holder and you are the public, then you will be expect means I will get the rate of interest in periodically, means you can put like that every 4 months I need that particular interest, then also you will get that particular interest in every 4 months. Or if you not interested to get that particular interest amount periodically, then also that will be available in the cumulative way, that will be available at the end of that maturity time. Okay, so the issuing the firm borrower means borrow money from the bond holder, promise to repay interest and the principal under the clearly defined the terms. Okay, so there all the thing is mentioned. On the basis of that they promise like that we will give you the 8% interest, like just example, and the principal under the clearly defined terms. Okay, so that is the thing. The key feature of the bond, just I discussed. The coupon means the amount of the annual interest. Okay, that means that organization will pay on that particular bond. So that is nothing but the coupon. Okay, next is the per value, means the amount of capital that must be repaid at a maturity, also known as a face value and the principal value. Okay, so suppose okay, so face value means this is the 1000 and written on that particular bond. There they will be write like 8.54 interest rate. I will show you some actual bonds so you can understand. So this is the face value. When the bond is launched, there they fix the sum amount, okay, on that particular bond. So that is the face value. What is the current yield? A measure of the annual interest income bond provide related to in current market price. So that I will be discuss. Okay, so yield to maturity, the yield or return earned on the bond from the time it is purchased until the maturity date of the bond. It is also discount rate used to value a bond. Okay, so just wait, means what is the thing is here, if there is the 1000 is the bond and they say 10% is the interest rate, so how much you will be get? 10% means 1100, right? So the next point is like that, this is the face value. Actually this is the face value, and they mention like the 10%, but in market that particular bond, on the basis of the demand and the supply, the price will be changed. Okay, so suppose this is the 1000 bond, but you are getting in 9000. This is actually known as a discount price. Okay, 900 means discount, means actual price of that particular bond is 1000, but it is available in 900 because there means supply is more and demand is less. Okay, and how much you will be get here, even you purchase this in 900, but you will be get the interest on the basis of this 1000. Okay, so 1000 10%, so here also you will be get 1100. Okay, and suppose there means the demand is high, supply is less, or here the price is 1050. Okay, and even after 10% you add, here also you get the 1100. The output will be same for all, because the company actually want to pay on this particular 1000 10%. Okay, after this particular bond purchased by the some person and they actually not interested, they sell that particular bond to the other guy in 900 in the discount price, then also it will not impact to this final money. Okay, and even he sell that particular in higher price, then also it will not impact. So this, the less price is known as a discount, and this price means when the price is more than the face value, then it's known as a premium. Okay, premium price of that particular bond. So the next call feature means it is allow the issuer to repurchase the bond before the maturity date. So in many bond they will mention, okay, 5 year is the callable time, means they will call. Okay, and the 10 year is the maturity time. So in that condition, that particular organization will take that particular bond, means again, and they will give you the money in within a 5 year. They are not interested to pay for 10 years. So in within a 5 year they will pay you entire money with the cumulative interest if you are not taken that particular interest monthly. Okay, so okay, this type of the means that type of the bond is the callable feature, you can say, that available in that. Why? Because they are paying you right now 10%, and maybe that particular organization arrange the money, they are arranged to money on the basis of the 7% interest. So they want to clear all these things which is actually given before, and now they will take this 7% this particular thing, and they generate the fund. So that type of the feature is available. So they already mentioned like that 5 year is the call, and the 10 year is the maturity period. So it varies. Okay, I'm just taking the example. The time duration varies organization to organization and the bonds to bond. The freely callable and non-callable and deferrable call. Okay, so there is some callable, there are also some non-callable. So even they getting in the less interest, but they not call because they are not mentioned before to all the public. Okay, so issuer will exercise the call feature when the interest rate fall. So the issue can refund the issue at a lower cost and issue new bond at a lower rate. It's the same thing, means if they launch earlier the bond and their interest rate is the 10%, so even they can call that particular bond after 5 years, and they means give all the money to the public, and now all the thing is settled, and they will take the new, and they maybe launch the new bond, they are 7%, and they get again rise the fund. Like that strategy generally organization use. So the what is the yield time means actually yield time measurement. Okay, so what is the thing is here, yield means how much return will get on that particular bond, how much return. So they are 10%, 5%, 8%, whatever the mention, that is nothing but the yield. So yield is equal to interest you got divided by the bond price. So 100 interest I am getting on the 10,000, on the 1000 I am sorry, then the yield is the 10%. But yield to measurement means here what is the thing, all the interest you got on bond and premium and discount you got at a time of purchase. Okay, so YTM means why it is fluctuating. Suppose you buy a particular 1000 bond and you got the by 10%, there is the 1100 in 1000, and this is the discount price, then also you got in 1100. Here the price is 1050, then also you will get the 1100. Why? I just discuss. Okay, so now the next point, this is the discount price of that particular bond. But YTM, what shows the YTM? How much actual percentage of the interest, how much actual percentage of interest. So you can say that is the 1100 minus 900 divided by 1100, that is the percent, right? So it is maybe, you can say, okay, so this is the all thing. So yield means the 10% you will be get here. But when I talk about the YTM, yield time measurement, so here if you get the discount price, then also you need to calculate how much actual percent in 900. So here you can say 200, so actual is the 20% here, so YTM is 20%. Here I think you will get the approx 7% like that. Okay, so that is nothing but the YTM. So here one bond is mentioned, this is the State Bank, there already they 1000 is the price of that particular bond, and how much interest they mentioned like that, just wait. The interest rate is not mentioned, I think. Okay, so this is the bond, and they actually interest rate is, I need to find out, actually I will see, but this 1000 it is shows like that they will this is the bond, just invest the 1000 in this particular organization SBI and you will be get the some return. Okay, so just wait, I will show you the some bond related thing, just wait, download. But again I am telling you what is the bond, just I discuss a long term contract under which a borrower agreed to make a payment of interest and principal on a specific date to the holder of the bond. Okay, so here the simple language, a written and signed promise to pay a certain sum of the money on a certain date or on fulfillment of the specified condition. All document, contract and loan agreement are bond. Okay, so that is the thing. And what is all the par value, coupon value, the maturity means a particular time period. Okay, there so what is the zero coupon bond? Many times the zero coupon means their interest rate is zero. So the interest rate is zero means you will be say okay, why then we need to invest. So interest 1000 bond and their interest rate is the zero, but that particular bond available in the market 500 rupees. So you can buy that particular bond in 500 rupees, and after 5 years maybe you will be get the 1000. So that type of this thing is actually available. So like that this all. Okay, I go to the government bond and all, just wait. So everything is mentioned like that here inside. You can see this is the yield 10.54 means that is the interest rate. This is the in every half yearly they will pay you the interest, and the maturity date is given here. So after maturity date you will get your money, principal amount again. So in every company this in Indian South just mentioned their yield is very high, that's why they are A minus. What is the A minus? Means their yield is high but safety is less. So that is the all thing. And Means I hope you understood what is the difference between the loan, share holding, and as well as the bond. Is there any doubt, class? So here you can see there is the RJSDL, means some maybe the government security fund is there, government of Rajasthan. Okay, they issues that particular bond, and that is the face value is 100 rupees. The coupon rate means the rate of interest, that is the 8.45. Issues date 18 October 2015, and the maturity date is 2028. Remaining 6 year 8 month 21 days. Tax free? No, it is not a tax free. Means at end of the when you got that particular amount, tax will be applicable. So interest rate is the simple. Semi-annual is the interest frequency, means in every year 2 times you will be get the interest, and the limit is actually needed for all. Maximum available quantity is 500. So like that you can see the all the thing. Okay, fixed income is a PSU bond is available. This is a 9.3. Okay, so there are all type of the bond you will be found. Government guaranteed fund, NBFC fund, tax free bond. Okay, I'm sorry, bonds. So that all the type of the bond is available everywhere. Their safety maybe in some in government fund you will be found more safety, but yield is less. When I talk about the other corporation bond, their yield is high, safety is less. That type of the thing you will be found. Okay, so that is the one way to generate the fund in any organization.